Welcome to the Slop Temple. We pray this video helps.
You begin by auditing what gives you an edge: skills, capital, and time. Combine a simple hypothesis with data access, price, volume, fundamentals, so you can test immediately. Once done, pick a time horizon. Intraday requires speed, swing allows more signal smoothing. Make sure to set risk limits: max drawdown, position sizing, dollar per trade, because control of losses preserves your ability to find future edges. Start small, iterate fast to avoid large, unrecoverable mistakes. Now you convert intuition into concrete rules. Exact entry signals, exits, stops, and position sizing formulas. No ambiguity. Backtest across multiple years and market conditions, including transaction costs and realistic slippage. This reveals overfitting. Once backtests look robust, run walk-forward or Monte Carlo tests to simulate variability. Make sure to document failure modes, what breaks your edge, so you can adapt when the market regime changes. Iterate until the edge survives realistic stress scenarios. Finally, deploy gradually. Paper trade, then scale into live with small capital while tracking P/L, win rate, expectancy, and execution metrics. Automate monitoring and alerts for latency spikes, unexpected drawdown, or signal deviation, because detection is faster than intuition. If performance degrades, stop new risk, roll back to the last proven rule set, reduce size, and rerun tests. This is how you preserve capital. One key troubleshooting tip: if unclear, pause trading, review logs, and only resume after a documented fix.
Thanks for watching. Consider subscribing if we helped you.